Hi, everybody, and welcome to our March edition of GlobalView. For those of you who are new to FrontierView, we're part of FiscalNote's Geopolitical and Market Intelligence Business Unit. At FrontierView, we work with as a trusted partner at over 300 multinationals, supporting senior executives such as VPs of region, CFOs, and strategy leads. Our focus is on powering strategic planning, market monitoring, and international growth. And for that, we have dedicated practices across the globe, covering North America, Latin America, Europe, Middle East and Africa, Asia Pacific, global economics, and healthcare. And we work with clients across a number of different sectors, including consumer goods, healthcare, B2B, and tech sectors. Today's edition is a little bit different. We are here to share with you some of the insights we're getting from client conversations and client events that we've run recently. A lot of feedback in terms of what's on the minds of senior executives at large multinationals and what are some of the questions that they're really looking to tackle. I'm joined today by Mark McNamee, who runs our research practice for Europe. And he's recently had a series of discussions with clients, as well as an event that was of quite a lot of interest. So we will share with you some insights and ideas from everything that we've been hearing. Mark, welcome. Thanks for joining us today.
Great. Thank you, Martina. Glad to be a part of this again.
Wonderful. So starting around the world, we hold client events pretty much on a regular basis, at least a couple of times a month. And I just wanted to give some examples from some very recent ones that we ran. Actually, starting west in LATAM, recently we had an executive event for our heads of Latin America out in Sao Paulo. And a lot of the discussion there was actually a little bit more focused, of course, on the dynamics in that region, with some of the political risk and uncertainty that is always a tricky part of running LATAM, but focus also on Brazil and Mexico, which this year are going to be a little bit more stable and predictable, which is good news considering they're the biggest piece of the LATAM portfolio. Quite a lot of the discussion focused on really growth opportunities and also the balance between pricing as well as volume increases. And here we're sharing just one example of some of the live benchmarking that we ran with the group in terms of how companies are thinking about hitting top line growth this year. And as you can see, continued interest in doing price increases. Some of the additional benchmarking that we did indicated uncertainty around price sensitivity. It really is a theme that is not just a LATAM one, but across the globe, where planning and demand planning in particular is still a bit of a tricky piece for what companies are trying to do. A lot of uncertainty in terms of how much price sensitivity they're likely to hit at what point this year. But the intention is still to grow top line and in particular to offset any demand decreases with price increases. So just a tidbit from our LATAM conversations, but moving on to Europe, Mark, is this consistent with what you have been hearing from clients as well as you're thinking about growth in Europe? And what else is top of mind for executives in that region?
Sure. So some things, of course, are relevant. There are obviously global dynamics at play. As it pertains to Europe, the most pressing issue, of course, relates to the energy crisis as well as the high food prices. So yes, inflation, these dynamics have been with us for some time and are here to stay. If you look at the growth levels here, what's particularly concerning is that those traditional areas of growth in those core markets like Germany and the UK, you're seeing so much weakness and relatively prolonged. Nothing disastrous, but of course, weaker than historic levels. And also these are the core markets you'd rely on typically. The positive news is that those weaker Southern European markets are actually showing greater resilience. So that's better off, of course. But UK, of course, struggling with a bit more from the Brexit pressure. Germany, so reliant on the Russian gas in particular, so the energy crisis having more of an impact there. So in either case, you see more pressure in those two markets in particular. But sort of moving from the macro level and kind of getting into just sort of the sentiment what we're hearing at, from some of the clients. One thing I think that was kind of reassuring was that we have been telling clients basically since the war, so over a year ago, that this war has initiated a global transition, and doing business, whether in Europe or anywhere in the world, but particularly in Europe, is going to be fundamentally different. You're taking into account far more macroeconomic issues and risks, as well as political security issues and risks, and what this will mean then for your portfolio. So that's one thing, is that we actually heard clients finally kind of telling us in recent months, as well as the Vert, that the old ways have kind of been thrown out the window, and now they're actually kind of looking at these markets fundamentally differently, and they should be, because this is true. We are going through a major global transitional period. It's very uncertain where we end up in the future, and however many years it takes to get to a sort of a new equilibrium point. But this is going to involve massive transition, considerable uncertainty, of course. And so this, as it pertains to government and to companies' reactions, right? This involves then being more agile, more scenario planning for more contingencies, more interdisciplinary approach when you're as far as the planning for these markets. And then also more vision towards the long term, more structured decisions towards the long term, as now we understand that a lot of these dynamics we've been seeing will persist, obviously, for several years. So I mentioned a lot there, Martina, but happy to go into more depth on anything else.
So we'll come back to supply chains, because of course supply chains in Europe have been thrown off course because of the energy price spike from last year. But let me just circle to the other part of EMEA, which is the Middle East Africa part of EMEA, very briefly, and then we'll come back to the supply chain discussion, because at our client event, of course, we try to support heads of Europe, Middle East, and Africa, and there's some growth opportunities across the Middle East Africa region. You can see some examples here from a growth perspective. A lot, of course, comes from the energy exporting markets that are still priority for executives. And the very, very short version of this is it's all about Saudi. So a huge amount of interest in terms of further investment in Saudi Arabia, considering also the shifting government policies and investment areas there, but also the pressures to localize staffing, the Saudi headquarters policies, etc. Just both an urgency to invest, but also a lot of operational challenges that companies are facing. And there was a lot of discussion at the event about, okay, how do you manage that tension? What can you do short term to really adapt to changing regulations, but in a way that makes sense for the regional structure that you already have built. So that would be one area that is really attracting a ton of dedicated attention, and frankly, probably competitive pressures as well. So not to say that the entire region is all about this, but really when we look at kind of the top priority from an opportunity perspective, if you don't get Saudi right today, then you are probably walking away from the biggest opportunity in the short term. So just some food for thought in terms of what companies are focusing on. But let's go back to the supply chain. So I tend to talk a little bit more to global teams. But even at kind of at the regional level as well, tons and tons of questions about supply chain restructuring. And here at FrontierView, we're about to launch a proprietary client survey to help us understand specifically what companies are doing, because there's a lot of hype in the media about supply chain changes. Clearly, companies are in the evaluation stage or about to make some changes, and they all want to know what everyone else is doing. And there's some very specific operational challenges around location, incentives. My customers want me to localize in lots of other places, just operational issues around the ultimate cost that a more diversified supply chain brings in. It's really like, it's like an onion that you start to unravel and becomes very complex. So at a recent event with heads of EMEA, we did have a discussion about some of these strategies and how EMEA fits into them as well, in terms of how companies are restructuring. I think it's clear from the data, this is from AmCham, that some companies, for instance, American companies, are moving some manufacturing out of China, or rather any additional investment they're making might not be in China, it might be somewhere else. More recently, it might be in the US because of some of the incentives there, but it also could be across places like Vietnam, India, etc. So there is a big question of who's going to win from this realignment, but also, of course, a question of how do you handle the role of China in all of this, and how does it all come together from an operational efficiency perspective, from a cost perspective, etc. At the event, I think there were a couple of interesting comments, and I'd love your take, Mark, as well. One was that a lot of this is a de-risking strategy in addition to opportunity-based. And whether or not your assumptions on the risk are correct, once you build in additional investment, you have to make the most out of it. It becomes a bit of a path dependency situation. So you're almost on this path of, no matter what, my supply chain will be diversified, and therefore I have to make that work financially and in terms of profitability. And the second point was interesting as well, because a lot of companies are looking at holding more inventories, having a more regionalized supply chain, partly because they see security of supply as a competitive advantage. Because of the disruptions to supply chains and availability of supply in the past couple of years, companies that were able to get customers reliable supply always at the right time in the right place were able to extract significant pricing increases from those customers. So it was profitable to get this right. Some companies are taking that lesson and extending it into their investment strategies going forward. It is a bit of an open question whether that really does remain a competitive advantage, or whether supply and demand dynamics normalize and then you're just sitting on a lot of inventory. But point being is there's a ton of learning and adjustment that is taking place, and it's a big open question for how companies are looking to evaluate it. And of course, Europe plays a big role in this. So Mark, what's your perception in terms of how companies are evaluating Europe when it comes to its future in their supply chains?
Sure. So a couple of points of agreement. So one, local distribution is critical. So the friendshoring, nearshoring, all these trends, right? So this is absolutely critical. We saw the chart earlier. So EU is obviously less appealing than some of the other markets where you're de-risking out of China. But that is still the remaining point, de-risking away from China. And that doesn't mean obviously sprinting out of Europe. There's just less appeal for Europe. A couple things related to this, more or less positive for Europe. One is that you can't just simply wish your supply chain problems away and just get out of certain product categories. Certain products they have to be they have these long production chains, and they're based in Europe, or parts of them are based in Europe, and they can't be simply removed. So that there is sort of a path dependency there to an extent. And then secondly, the long-term fundamentals for Europe are still quite strong. I mean, these are extremely wealthy countries, of course, rule of law, far less corruption, very wealthy, businesses with investment capacity, relatively speaking, lower interest rates, of course, and consumers with, adequate savings levels and consistently solid incomes, et cetera, et cetera. So that is going to continue to keep Europe very appealing. Now, that said, the big concern, and one of the questions we've been getting from clients for months now, as well as discussed at the recent executive roundtable, relates to the energy costs. How bad will they get this winter? Will we have a gas crisis and shortage and rationing potentially, as was concerned about this past winter? And then going forward, the permanence of this issue. And the reality is that, yes, we will have higher gas prices. They're going to spike to an extent this winter, but then also going forward, they're going to remain elevated for years ahead. That's on top of high food prices, which we can say comfortably are going to be high for probably at least the next, say, year and a half through all of next year, effectively. So that is going to be considerable inflation pressure that Europe is dealing with, that other markets likely would not be dealing with at that point, let's say a year and a half from now. So that, yes, naturally, this does create some issues for the investment appeal, which means one of our clients said at the executive roundtable, that just means Europe has to do a better job of making themselves more attractive in terms of finding ways to manage these markets better, internally, right? Finding ways to make these markets even more appealing, more innovation, more, better cost management as much as possible. Being leaner, of course, being more strict in your execution. So there are ways, of course, to sort of amplify the appeal, and there is a strong existing appeal within Europe. So that's sort of the big takeaway. And another thing, particularly related to inflation, companies have gotten very lean. They've gotten very conscientious of costs, of course, but they've gotten better and better at managing this cost situation as we've had inflation being more and more prolonged. And as one client said last week, we've learned you can't do everything for everybody. You can't make everybody happy all the time. And that's been obviously a key lesson learned from this high inflationary environment, that you have to pick and choose your battles and win where you can. And in some cases, that means you don't necessarily win everywhere. And that might have been the reality 5 years ago, and it's not quite the reality today or going forward.
Well, Mark, I don't know exactly how to complete this, because I think there are a lot of really interesting insights from this. And in the interest of time, I think we maybe wrap it up here, and we leave a lot of food for thought for our listeners in terms of how that relates to their businesses and how they're thinking about the implications for their operations. So a lot of interesting changes are happening, of course, within global multinationals and how they're thinking about their plans. It's really about this year's plan, but also about next year's plan increasingly as well. And hopefully some of these insights were insightful as you're thinking about your own planning season. So with that, thank you, Mark, for joining me. And thanks everyone for joining us. Looking forward to speaking with you next month at GlobalView.
My pleasure. Take care.